Anybody know, while we're waiting for people to come, anybody ever heard of your reticular activating system? Anybody know what that is? Reticular activating system. Put that in the chat if you know what the reticular activating system is. Because I had that working for me this week, and I want to just share a couple things about that. Anybody ever heard of your reticular activating system? Okay. Don't tell me nope. Tell me if you do know what it is. If you know what the reticular activating system is, like put it in the chat, please. All right, the reticular activating system is what kicks in. It's literally a part in the brain where, have you ever bought a new car and you never saw that car before, and then after you buy it, you see it everywhere?
Yep.
And I remember when I was learning vocabulary years ago, I was studying vocabulary, and I would get a vocabulary word that I'd never heard it before, and the next thing I know, it's everywhere. It shows up everywhere. That's your reticular activating system. So lo and behold, I knew that we were going to be talking about IULs, and so lo and behold, I get a visit from another provider, another insurance company guy that came to see me and took me to breakfast. And lo and behold, guess what he wants to talk about? IULs, but not in the way that, I mean, he knows that I'm a whole life guy, and he was talking about the dangers and the problems that are going to be besetting people who have IULs. So it was like singing to the choir, preaching to the choir. So today we're going to talk a little bit about, not a little bit, we're going to be talking a lot about IULs. So I'm going to start by showing you a video that I produced, and I think you'll find this interesting. So we'll start with this and go from there. So let me know if you can see my screen right about now. Whoops, I need to do that again. Always forget to, I need to change optimize it for sound and for video. So here we go. So you should be able to see that right about now, right? What are you seeing? Let's see. Okay, we've got a lot to go through. So yeah, I'd love your comments, but please hold them towards the end, because I think a lot of them will be answered, and we have more than information than I can possibly get through. So here we go. Maybe.
Showing millions of dollars in future tax-free wealth. You receive a projection from an insurance agent showing millions of dollars in future tax-free wealth. It looks perfect on paper, but mathematically, those projections are built on fragile assumptions. If the market falters, that perfect structure can shatter, leaving you with absolute zero. We recently reviewed a policy for a client who faced exactly this scenario. At age 53, he committed $18,000 a year to an indexed universal life policy, or IUL. Whenever you commit that level of capital to permanent life insurance, you are making a specific trade. You are trading early access to your cash for long-term security and tax-advantaged growth. The danger lies in how that growth is calculated. Insurance illustrations rely heavily on non-guaranteed projection pages, which assume the market always performs exactly as planned. But the actual contract is bound entirely by the guaranteed pages. That is what the company is legally obligated to pay if things go wrong. Choosing the wrong insurance structure can result in a total loss of your principal precisely when you need it most for retirement. To see how this happens, we set up a direct side-by-side comparison. We took our client's exact variables, issue age 53, $18,000 a year in premium, and stacked his IUL against a properly designed whole life policy. An IUL works by tying your returns to a market index. To protect you from negative years, the insurance company places a 0% floor on your account. In exchange, they place a cap on your maximum upside. This chart shows the flaw in how these policies are sold. Pitches often highlight an average return of something like 7%, but a straight average is a mathematical illusion. When you plot a jagged, volatile path of actual market returns against a straight average, the real compound yield ends up significantly lower. A 0% floor protects your balance from going negative during bad years, but it also means you earn zero interest. Zero interest stops the compounding process cold. Over decades, this drag limits your actual cash yield. Because the IUL shifts the risk of market volatility to the policyholder, any sustained period of underperformance legally threatens the policy's survival. Let's look at the timeline. By year 6, both policies have received an identical $108,000 in total premium. On paper, the IUL appeared slightly ahead in total cash value, showing roughly $95,000 compared to the whole life's $94,000. The IUL's active surrender fee drops liquid value to $88,000. Whole life has no fee, giving full access to $94,000. By year 10, whole life reaches $175,000. Crucially, its yearly cash growth now permanently outpaces the annual premium. Because whole life completely avoids early surrender fees, it provides superior early liquidity. If you plan to use strategies like infinite banking, where your capital must remain accessible to borrow against, whole life is the superior tool. In year 11, we execute a structural change to the whole life policy. The premium drops sharply from $18,000 to roughly $6,400. We make this adjustment to avoid crossing the IRS Modified Endowment Contract, or MEC, limit. Lowering the premium maximizes the tax efficiency of the policy while keeping the growth tax-free. In year 12, whole life's total cash value officially exceeds the money paid in. The IUL doesn't. Despite $216,000 paid, it holds only $180,000 in cash. By year 14, the IUL finally sheds its active surrender fee. By year 14, the whole life policy has achieved high capital efficiency with lowered out-of-pocket inputs. The IUL, meanwhile, has effectively trapped the client's capital for over a decade. Moving to year 23, the whole life policy experiences its final adjustment. The out-of-pocket premium permanently drops to $0. At this stage, the guaranteed death benefit locks in securely at nearly $477,000 for the rest of the insured's life. The IUL provides no such relief. It continues to relentlessly demand that $18,000 annual premium just to stay active. This sets up a dangerous turning point. In year 29, the guaranteed cash, surrender, and death benefits of the IUL stop growing. They suddenly pivot and begin to decline. As the insured ages, internal mortality and insurance costs inside the IUL rise dramatically. These costs start cannibalizing the policy from the inside out, eating away the cash value beneath the surface, despite steady premium payments. By year 42, the math catches up. The IUL's guaranteed cash, surrender, and death benefits are all zero. Meanwhile, whole life remains rock solid, providing nearly $430,000 in cash and a death benefit, with no premiums paid for 19 years. Contractual certainty is what secures your retirement. When you rely on market-dependent non-guarantees, a single prolonged downturn paired with rising internal costs can wipe out your entire safety net. Let's tally the final lifetime inputs. Over 42 years, the IUL demanded over $750,000 in total premiums, yet legally guaranteed absolutely nothing in return. The whole life policy required only a fraction of that in total premiums, around $257,000. In exchange, it guaranteed nearly double that amount in tax-advantaged cash value. Preventing an IUL from imploding late in life requires continuous, heavy overfunding to keep pace with skyrocketing internal insurance costs. A whole life contract forces the insurance company to bear the risk of performance. An IUL forces you, the policyholder, to bear it. IULs market the illusion of infinite wealth through market upside, but their structural design leaves you legally holding the bag if the market falters. This chart breaks down the correct tool for your primary financial goal. If you need guaranteed liquidity or legacy protection, whole life is the clear path. If your priority is pure market upside, you should exercise extreme caution with life insurance and consider term policies paired with separate investments. For those practicing infinite banking, the absolute early liquidity and predictable certainty of whole life is a requirement. You cannot safely store and borrow capital from asset that fluctuates with index caps. And if your goal is guaranteed legacy protection, an IUL introduces the catastrophic risk of your policy collapsing entirely in your 80s or 90s. A well-designed whole life policy is the objective, mathematically superior choice for anyone who requires absolute certainty, liquidity, and control over their permanent wealth.
Okay.
You receive a projection from an insurance agent showing millions of dollars.
Sorry about that. So I have to tell you a personal story. Let me maybe bring this down if I can, see if this will work. Okay, it's not showing here, is it? Let me try this again. Okay, you can see that. All right. So I have to tell you a personal story. My brother he passed away. My brother was 11 years older than I was. 12 years older, sorry, 12 years older than I was. He was an entrepreneur. You guys have maybe heard of Elon Musk. Elon Musk has something called Starlink, and Starlink uses a frequency to communicate to the Earth through radio waves, basically. Well, those radio frequencies were auctioned off years ago, clear back in probably the late 80s, early 90s, something like that. I guess it was early 90s. And my brother's business, his company that he headed, won the contract to those frequencies. Lo and behold, he has a stroke. I get a call from my sister-in-law, and this stroke went on for months and months and months. And I'm talking to my sister-in-law, and this is back before I was doing anything with insurance. And she tells me, she says, Jim, I said, how you doing? And she says, well, it's been tough. He's lost his businesses. All the things that he's worked for all of his life, they're all gone. And I've got this insurance policy. It's a universal life policy. And she says the cost of the insurance keeps going up and up each year, and it's gotten more and more expensive. And she says, honestly, I think I can make one more payment, and that'll be it. I can't do it anymore. I just can't do it anymore. She made that payment, and he died before the end of the 30 days. It was up after the policy was paid for. So it paid a claim. Now, had she not made that claim, had she not made that payment, they would have put all this money in for all these years, and I don't know how much it was. It wasn't my business to find out, but they would have lost it all. As it was, it paid off. Now, how in the world does that happen? One of the things you need to understand about universal life is that 95%, I would dare say, of the people who sell it have no idea how it works. You've seen Christy, those of you that are clients, you've seen Christy go through and take things apart. Well, I did the same thing with IULs because at one point in time I thought IULs were a pretty good deal. Now, the problem is the universal part of it. It's index universal life. My brother had a universal policy, which was before the index, but the problem is the universal part of it. And the reason I say that is this is what a universal policy is built on. And I think as we get into this discussion, it's important for you to understand and see this. So let me make this as big as I can right here.
Thank you. There was a few requests for that, Jim. Thanks.
Yeah, sorry. So this is on a 35-year-old. So this is a year later. Oh no, I guess it's a 36-year-old. Okay. So this is a 10-year term. And this is a non-convertible term, which means this is the cheapest kind of term you can get. So notice how this policy starts out at $229 a year, $229 a year for $1 million worth of death benefit. Sounds wonderful. But then at the end of the 10th year, look what the price jumps up to is $8,310 for the same amount of death benefit. And then it goes to $8,670. Well, why is that happening? And the answer is because what this life insurance, term insurance, was years ago, that's all they had was term insurance. And what the insurance companies did was brilliant because what they did was they averaged these out over a period of time. And so that 229, they overcharged in the early years, but they leveled it out. So this is a level term insurance policy. Once the level portion is up, in other words, the 10 years is up, then it goes to something known as annual renewable term. You can keep the policy, but the price is going to go up. They guaranteed the price for 10 years. But at the end of that 10-year period of time, the cost is going to go up, and it's going to go up every single year because you're closer to mortality This is how life insurance in the early days was termed. This is how it was sold. So this is the actual cost of the insurance. Now, what I want you to understand is, let me go over here. This is talking about, oh yeah, by the way, so one of the things we say is that people, Nelson would say this, people don't die before age 65. They start dying at age 65. Imagine paying $32,000 after you've paid all of this in for all those years. People drop it. That's why term insurance policies, less than 1% of term insurance policies ever pay a death claim. Now, I'm not talking about riders, I'm talking about pure term insurance. Okay, so then I can't do it for him, honey. I told him to call me first. Okay.
Just is here.
Okay.
at the door.
Okay. All right. So this is what the cost of the insurance, it keeps getting more and more expensive year after year after year. Okay. Now, if you look over here, if we take a look at this, here is a 15-year term. Here's a 20-year term and a 30-year term for the same amount of death benefit. You'll notice that the longer you have it, the more expensive it's going to be. Okay. And you'll notice that this annual renewable term, then when you get to the 15-year, it's the same price. In other words, this is the cost of the annual renewable term. Now, why that's important? This is how all universal life policies are based on this chassis. In other words, it's an annual renewable term policy. They don't level it out. It's an annual renewable term. So it is guaranteed to get more expensive every single year. Remember when I was telling you that my sister-in-law said that she couldn't continue to make the payment? Okay, that's why, because the costs get more and more expensive. So that's one of the problems. Now, having said that, I need to show you something from the New York Department of Insurance. And this will be kind of hard to read. So let me see if I can make this bigger for you. So this is not there anymore. So I took a screenshot of that, but this is a warning from the New York Department of Financial Services warning people about universal life insurance. And it says, I see if I can read this. It says universal, I can't read that, it's too small. Yes. See if I can make it any bigger. Universal life insurance comes in many varieties, including fixed universal life, which is what my brother had, variable universal life, indexed universal life, which is what we're talking about, and variable universal, we're talking about variable life. Beware of increasing charges. The internal charges of universal life policies can increase every year. That's really inaccurate. They do increase every year. Ongoing premium payments, the policy's existing cash value, and ongoing internal interest rate credits or investment performance in the case of variable universal life insurance are all used to cover the policy's internal charges, which increase each year as the insured gets older and can be very high in later years. Now, I need to pause right here. I've been doing this with universal life. I've been around universal life policies now for over 30 years. And I can tell you that I have never, ever, ever, ever seen a universal life policy or a variable universal life policy or an index universal life policy, IUL. I've never seen one yet that either wasn't imploding or was about to implode or would eventually implode. What do we mean by imploding? The cost of the insurance eats up anything that you're making in the market with the variable universal life or with the indexes with index universal life. So what you're betting on is that you're going to be able to outpace with your investments in the investment side of the policy or the index side, that those will actually outperform what the cost of the insurance it will be. And that's a losing battle. The insurance companies know exactly how many people are going to die your age. They know exactly how many. They don't have to guess. They have the numbers for it. That's how they make their living, is knowing that information. So you're betting that the insurance company doesn't know what they're talking about. That's a losing battle. Okay. Your premium payment amount is probably not guaranteed and may increase. Most universal life policies do not provide long-term guarantees of premium payments, cash value, or benefits. In other words, and this is important, with your whole life policies, the ones that we do, everything is guaranteed except the dividend. Now, the dividend, if you look at your policies or if you look at an illustration, the dividends are minuscule compared to what the policy is doing. The policy is growing with or without the dividends. So if you look at this, that's what the dividends are not guaranteed, which means they can go up. They can also go down. But you've got guaranteed death benefit, and you've got guaranteed cash value. When the cash value is there, it can't go down. Now, in a variable universal life policy, the values can go down. That's one good thing, if you will, about index universal life is that once the value is established there, it can't go down. That's what they mean by the floor. Okay. However, if everything else is going up as you saw in that video, and the cost of the insurance is going up every year, it can actually cannibalize itself. So we do infinite banking, and with infinite banking, we want access to capital. And some of you have heard me say this before, but access to capital trumps rate of return. Because you can have a great rate of return in your 401k, you don't have access to it. Yes, you have access to maybe 50,000 unless you've already got a loan against it. But you have access to capital inside your life insurance, inside your whole life insurance policies. You don't have that with an IUL. And I can show you some examples. Let me show you one right here. Let me do this one for you. Okay, so here's an example of an illustration. And by the way, averages, and we've talked about, and well, some of you are new to this, but averages don't mean anything. The average, what something earns as average, it doesn't necessarily mean that's what you're going to get. But here's an illustration. This person is putting in $44,000, and they'll give you something called accumulated value, which is $38,000. And you'll see cash value right here, which is $10,000. There's the death benefit. And here's your accumulated value at the end of the year. There's your cash value. But here's the part they don't tell you about, and that is your cash value is, if you look out here, the accumulated value and your cash value right here are not the same. See that, how much different they are? That's because there's, in this particular instance, this particular policy has a 10-year surrender charge. What does that mean? Means this is what you have access to, not the 44, not the 38, but 10. And it takes 10 years before that goes away. Then starting in the 11th year, then it's the same values going forward. Okay. Now, one of the problems with these IULs is that one of the selling points, if you will, that an insurance person will tell you is that, oh, you don't have to put in all that money. You can put in less than that. That's a recipe for disaster, because you need to be max funding it. The only IULs that I've seen that do fairly well are those that are maximum funded, but that's not how they're sold. They're sold by saying you can adjust it. You can adjust the amount of premium that you're paying. Well, you're also going to adjust the death benefit, and everything is going to be adjustable. But the problem is that you don't control those. So I want to show you something from Nelson Nash's website. If this is the one I have right here. Yeah, this is from Top 10 Reasons Not to Buy IULs. Now, Nelson was adamant. This is back in 2012 when he was still alive. But Nelson was adamant about people not using IULs. Now there's a lot of people running around loose saying, "Oh, you can use an IUL with infinite banking." It's not a good idea, and the reason is you don't have guarantees. You want those guarantees. So internal costs are not guaranteed. We just showed you the cost of the insurance is guaranteed to get more expensive every single year. And I would be willing to bet next month's income that the people who are selling this don't know that. They don't know what the internal costs are. They can't calculate it. But if you understand it, again, it's an annual renewable term. The mortality charges are not guaranteed. Now, who can change the mortality charges? It turns out that everything in an IUL can be changed by the insurance company. For example, let's see if I can find this piece that I wanted to show you. If you are late on your premiums, the guarantees go away. If you miss a payment, the guarantees go away. Here we go. Let's see if I can bring this down and show you this. Whoops.
Jim, if you look at a whole life contract, the amount of pages that you'll have on there versus an IUL contract is about half.
Yeah.
And the reason why is because it's kind of like a mortgage loan document. Does anybody ever read every single page of that document? Probably not. The IUL documentation is very similar. There's so much crap in there that no
Adam,
one ever reads.
we can barely hear you.
Yeah, you're very soft, Adam.
It's so weird. Why is that? All right, I'll figure that out before I talk more.
Okay. So this is any one of a number of changes or events during the life of a policy can result in either the loss of the no lapse guarantee, in other words, losing the death benefit because of if you lapse the policy. In other words, they have a guarantee that if you're not making your payments, it guarantees a death benefit. However, if you miss a payment, you can lose that guarantee. And that's always done by a secondary death benefit that's included in there. And these things are like a late payment, a skipped premium, a policy loan. Hello? If you're using this for infinite banking, you just, in many cases, depending on the company, you can end up losing the guarantees. So you take a loan. Well, isn't that what we're doing with infinite banking? Yes. Well, you could lose it. You could lose the guarantees or a withdrawal, a non-scheduled change in the face amount. And guess what? An IUL allows you to make a change, but if you do with certain companies, they will cancel the guarantees that are there. A change in the death benefit option or the addition of a rider or other benefit after the policy has been issued. Okay, so universal life has been offered as an insurance option since the 1980s. The major concern for the policyholder is the policy will lapse if the cash surrender value falls to zero. This may happen if one or more of the following conditions prevail. The policy was inadequately funded with premiums. And again, this is how they're sold, is you don't have to make those premium payments. And so this plays to the scarcity mentality. There's a difference between an abundant mentality and a scarcity mentality. And people who have a scarcity mentality are always trying to sneak by, and they want to have the least amount, they want to pay the least for anything. They don't understand that a whole life policy, the more you put in, the more benefits you get. It's just the opposite of what we're doing here. The actual interest rate credited over the life of the policy was inadequate, or the mortality and expense charges were increased, thus dissipating the policy's account value. And so I thought I'd give this to you real quickly too. Here's a brief history of how we got to universal life. I think it'll help. There used to be a company called E.F. Hutton. Do you guys remember what E.F. Hutton's moniker was or what their phrase was? When E.F. Hutton speaks, people listen.
Everyone listens, yeah.
Okay, well, guess what? E.F. Hutton quit speaking years ago. E.F. Hutton doesn't even exist anymore. Okay, but in the 1980s, to compete against buy term and invest the difference of the A.L. Williams termites. Now, this is interesting to me because Christy and I both know a lot of people who were in A.L. Williams in the beginning days. Okay, and these guys are still around. They've rebranded themselves, but it's buy term and invest the difference, which we can do a discussion on sometime if you'd like to too. But A.L. Williams termites were making an inroad, and so E.F. Hutton developed this universal life concept. The investment firm, and that's who they were as an investment firm, is now part of the Citigroup family. I take that back. They are still a part of Citigroup. E.F. Hutton is still remembered for his catchy phrase slogan, when E.F. speaks, people listen. Whereas if E.F. Hutton today, and by the way, Nelson wrote this, where is E.F. Hutton today, and what are they saying? Well, it seems like people stopped listening when E.F. Hutton had charges of check kiting and money laundering announced. His firm, founded in 1904, grew to become one of the most respected U.S. financial firms, and for many years was the second largest brokerage in the United States. But in 1980, some Hilton branches began shifting funds from one account to another, effectively giving interest-free loans until the checks cleared. Sounds like banking to me. Again, this is Nelson. Of course, the scheme eventually came to light, and in 1985, E.F. Hutton pled guilty to 2,000 counts of mail and wire fraud. The SEC allowed Hutton to stay in business. Okay, that's how he comes. So then he goes on. Several mergers later. So listen to this. Universal life products are designed to shift the mortality and mortality and investment risk. That's insurance speak for mortality is death benefit. The cost of the insurance, if you will. When you talk about a cost of insurance, we're talking about the mortality charges, to be more specific, and the investment risk. Okay, in other words, what they're doing is they're shifting the mortality and investment risk to the policy owner, with rate guaranteed during the first year, but subject to a maximum mortality rates as guarantees during the first year, but subject to maximum mortality rates and minimum interest rates during the subsequent years. The universal policies offer high yields the universal policies offer high yields near money market rates on savings elements, an element that resembles traditional cash surrender values in name only. So anyway, that's all you have to do to know is to figure it out. You can put that into Chat GPT and it'll produce an index universal life policy. That's all you got to do.
Simple.
So let's take a couple of questions before we go and make sure I'm heading in the right direction with you guys. Shane, have you got some that you can read for us? Some of the questions they're asking?
No, a few people are asking how they could possibly get some of these documents or that video you shared earlier.
Okay. So I'm glad you asked about the video, because the video is something I'm wanting to put this into a course that you guys will have access to. This video that I did, I want to show you one more here in just a second, is a part of that, because I think this is one of those areas we keep hearing, and people, I thought by now this would have died away, and it hasn't died. It's still every bit as involved in now as it was before. So let me show you this one other one, but you'll be able to go, those of you that are clients of ours, you'll be able to go onto our website, probably, I would say tomorrow or Monday for sure. You'll be able to go and see it there if you're already working with us. Okay, and if you're not, you should be. So here you go. This is another one that talks about the same thing, just a little bit different version of it.
At its core, an insurance policy is a simple mechanical trade. You pay a premium to transfer your financial risk onto a heavily capitalized institution. But today, people shopping for long-term coverage face a confusing choice between whole life and universal life. The financial industry markets both as permanent, lifelong solutions, often presenting them side by side as if they were nearly identical. Read the actual contract language, though, and that equivalence falls apart. Deep inside the fine print, these two policies are engineered to execute completely opposing financial functions. One is built from the ground up to mathematically guarantee wealth preservation. The other is a hybrid vehicle. It wraps temporary term insurance around a speculative savings account tied to the unpredictable swings of the stock market. The danger of confusing the two is severe. Many policyholders only discover they've purchased a speculative product decades later, when their coverage begins to collapse under mounting internal costs, just as they enter their 70s or 80s. Selling these as an apples-to-apples comparison is a deliberate industry illusion. It masks a quiet, massive shift in financial liability away from the insurance company and directly onto you. Let's look at how the older, historically tested model works. Participating whole life insurance is built on strict fixed premiums and a death benefit that is mathematically assured from day one. The mutual companies that issue these policies price them using extreme pessimism. They calculate your premiums based on the absolute highest possible administrative expenses and mortality costs. They plan entirely for worst-case scenarios. Because they price for the worst, actual operating costs almost always come in much lower. When that happens, the company is legally required to return that surplus to you in the form of a dividend, directly boosting your policy's cash value. This chart shows a detailed illustration of a whole life policy's performance over time. Notice the green net cash value column. Because the policy is heavily over-collateralized by that extreme pricing structure, the cash value is mathematically guaranteed to grow every single year. Look at how this projection continues into the later years. The cash value compounds uninterrupted right through ages 63 to 90. The internal mechanics of the contract protect it from whatever the broader economy is doing. With a mutual whole life contract, the institution absorbs 100% of the downside economic risk. Universal life emerged from a very different environment. In the late 1970s, as interest rates spiked, brokerage houses on Wall Street wanted a product that could chase those high yields. They created a hybrid, wrapping temporary term insurance around a market-based savings vehicle. They marketed it primarily on its flexibility. Policyholders were suddenly free to raise or lower their premium payments and adjust their death benefits at will. This chart illustrates the hidden baseline inside those contracts. Unlike whole life, universal life projections are calculated using the absolute minimum possible operating costs. That makes the initial premiums look incredibly cheap. But as the policy ages, the true cost of that term insurance and internal administration naturally increases. When actual costs exceed that flat minimum projection, the insurance company extracts the difference directly from your cash value to cover the gap. This triggers a catastrophic failure cascade. Once the cash value is fully depleted by those rising internal fees, the only way to keep the policy afloat is to cover the shortfall out of pocket, causing required premiums to violently spike. If an aging policyholder, now on a fixed income, cannot afford those massive sudden payments, the remaining guarantees are immediately canceled and the coverage implodes. That highly marketed flexibility is actually a contractual loophole. It allows the institution to legally shift the entire burden of market volatility and aging directly back onto the consumer. Mashing pure insurance protection together with stock market speculation is like trying to build a racehorse and ending up with a camel. You get a compromised hybrid that excels at neither function. The legendary investor Benjamin Graham, the man who mentored Warren Buffett, built his philosophy on one core truth. The future of security prices is entirely unpredictable. That unpredictability dictates how you should structure your assets. You can afford to take risks and act as a speculator with your broader investment portfolio, but with your life insurance, you must act strictly as a saver. True permanent insurance is designed to be the bedrock of your wealth. It is engineered to endure extreme market volatility, deep recessions, and even global depressions without losing a single cent of your principal. Look past the optimistic projections and sunny sales illustrations. When you evaluate an insurance policy, you have to demand to know exactly what is mathematically guaranteed in the black and white language of the private contract. True financial security comes from building your foundation on strict institutional guarantees. By locking in those assurances today, you ensure that even if the broader economy fails, your legacy never will.
Comments?
I have a comment.
Go ahead.
Because you guys, our policies have a term life insurance wrapped around it. The difference, I'm just saying this out loud so I understand. The difference between ours is that it's not tied to the market. Is that correct?
Well, you have a term rider. Okay, it is not the same as a term insurance. It's a rider. The main part of the policy is the whole life. The rider is what gives us that extra boost to allow us to put more money into it and not become a mech. That's what the purpose of the rider is for.
But isn't that also to help keep costs down for us?
Yes.
Okay.
Yes.
Okay.
Yes.
I wanted to make sure I said it, understand it.
Yes. So the IRS, and this is one of my favorite quotes. The IRS doesn't care how much money you put into a life insurance policy, as long as you have more death benefit than you have cash value. And so the term rider is there to boost that up a bit so that we're not having to fund the whole thing with whole life, which would be very expensive. Okay. That's the purpose for that. Okay. Couple more things I want to show you on here. Give me just 1 minute here. If you've got questions, if you want to blurt them out now, it'd be a good time to do it while I'm finding this.
I got a question.
Sure.
Just what, how is it that you're, I guess, or why does the rider not increase like after 10, 15 years as well? Like, how is that?
Okay, good question. Because if you looked at the illustration, there's actually a section that you can look at that shows you exactly what's happening. And what's happening is, again, to get as much cash value in there as possible, we have the whole life portion, and then we add a term rider on that. And what's happening over little by little is the term policy is being kind of bought out, if you will. So in a sense, it's like a decreasing term. You can cancel it at any time, but as long as you're putting money into the policy, you want it because it allows more money to go into the policy, more money to end up in the bottom line in the cash value. Does that answer your question?
Explain that one more time, because one more time.
Ask me the question one more time, then, and I will.
Trying to figure out what keeps the term rider from increasing annually, like the IUL after 10, 15, or what have you.
Okay, so with insurance, you can have with term insurance, you can have an increasing term insurance, you can have a level term insurance, or you can have decreasing.
Okay.
A good example of decreasing would be if somebody talked to you and say, well, you've got a $300,000 house. I mean, this was done years ago. You don't see this very much anymore, but the idea was that you have a $500,000 house, and a decreasing term policy would, if you died, would pay off the house. But as you pay down the house, then you don't need that much death benefit. So it's a decreasing amount.
Okay.
So the term rider is for all intents and purposes is decreasing along with it. Now there are companies that you have a term rider for 7 years, for example, because that's the MEC limit again, 7, 15 years or so forth. And if you don't cancel it, it increases every year after that. But so think of it as a decreasing term policy. And if you want to see that, I can actually take you to your policy itself. And there's a printout that we can print out that shows you exactly what's happening and how it's being bought out.
Okay. All right. Thank you.
Good question. Any other questions?
Jim, can you hear me okay now?
Sure.
Yeah, just to touch on that last comment, when you're buying paid up additional insurance, which is coming from putting in paid up additions, right? The portion of your total death benefit is turning into more permanent death benefit, thus decreasing the amount of term that you have, if that kind of helps make sense, hopefully.
It does.
Okay, good.
All right.
Thank you.
So let's see what else I've got in here. Here's one of my favorite quotes, and that is, "The large print giveth, the small print taketh away." And when people have asked me to evaluate their IULs, I always look for that language in there, and it'll say something like a policy change. Well, look at this. Who determines what those policy changes are? And the answer is not you. The insurance company decides what that is. And so here's another thing you need to know about universal life, and that is that a variable universal life, you're actually investing in something that looks like a mutual fund. Indexed universal life, you're not investing in the market. You're being paid as if you were. In other words, they're paying you per what the indexes would be doing. Okay, so now I lost my train of thought. Sorry, guys. Where was I going with that? Shame.
You don't have any control of what happens to the
Yes.
policy. They make the changes.
Okay, so in a variable universal life policy, because you're invested in a mutual fund, it's a mutual fund like in environment. In other words, it's not a mutual fund because they can't call it a mutual fund, but it's managed by managers who manage mutual funds. It looks like a duck, quacks like a duck, but they have to call it a separate fund. So inside that separate fund, inside of a universal life policy, if the company is starting to lose money, they can increase the mortality charges. They can increase other fees that they start adding to it because the contract gives them permission to do that. So in other words, they control all the levers, not you. Let's talk about a whole life policy. When you see a whole life policy and you see how it's laid out, you know exactly what the cost of the insurance is, and it does not change. It doesn't go up or down. They peg that to begin with, and that they cannot change it. And a universal life policy, not only they can, but they do when the stuff hits the fan. And I don't know about you guys, but the stuff always hits the fan. With whole, I mean, this is why I tell everybody. I talked to some people this last week, and I always tell this story. Our favorite company's been around since 1847. That's 179 years, you guys. They've been profitable every single year. And you can't say that about a mutual fund. You can't even say that about most banks. You certainly can't even say that about real estate or stocks or anything else. These have been steady Eddie, and they've been the bedrock for how people have built their empires long before we got into the stock market and so forth. Okay, the guaranteed values illustrate a worst case scenario and assume minimum interest rates and maximum policy charges are applied in policy years. Non-guaranteed values are on interest rates and policy charges, and they are subject to change. Because of this, we cannot promise that your actual policy values will maintain the non-guaranteed values in illustration. In other words, we're still talking about that kind of like all bets are off because they're not guaranteeing those. They're not guaranteed. And let's see what else I got here. Let me go back to this one. This is the one I think you're probably going to want to see most of all, which is the one from the New York Department of Insurance. And again, if you go to the Department of Insurance now, you're not going to see that, but it's warning you exactly what happens when these things implode. Now, hopefully you'll understand what we mean by imploding, that they're imploding. If you buy a universal life and you can cancel within 10 days, notice they're telling you that under New York free look provisions. So they're encouraging you to do that. They don't say this. I've never seen this about any other insurance, but they're talking about it with universal life policies. So anyway, let me open this up for questions and answers. Any things that you guys have questions about, maybe I can answer for you.
No, but I tell you now, had I not, I've been burned by the term insurance thing, and had I not found you guys through the RYU pipeline and went through your education process, I would have said, nope, insurance company, forget it. No. So it's really helpful in that you guys teach this every single week. You want your clients to feel comfortable and informed. And I, for one, really, really appreciate it.
Well, good. Thank you. Yeah, it's this is too serious of a matter, I think, to not really understand it. And you need to understand it. And I don't feel the least bit bad if you ask lots of questions, because you should be able to ask questions and understand it. So I'm going to see if I can show you, Curtis, your question here, and if I can pull it up here in a second. Other questions while I'm doing this, you guys?
You've probably said this, it's Donna, but how is the increase not affected by the market? How is it guaranteed?
Perfect question. Okay, so this is what's called a non-correlated asset, which is a fancy word of a way of saying it's not tied to the market. There's nothing in the market. You're not the only market. The only tie is to the outside world. The only tie to the outside world, if you will, is that if the economy is doing well. Well, let's go back 5 years ago. What were interest rates 5 years ago? High or low?
Low.
Low, yeah.
Zero.
Yeah, they were clear down to zero. Okay, that affects the ability of the insurance company to lend money. So when they're lending money, they have to compete with what else is going on in the general economy. But what they're doing is they're buying bonds, you guys, And a bond is nothing more than an IOU that a municipality or a corporation or an entity of some kind is issuing a bond. For example, when you're the closest thing that you would have seen is when you were raising your kids and the school floats a bond. In other words, they need to build a new building. Okay, how does a school district pay for a building? They don't have $10 million laying around in cash.
Bond measures.
They have to float a bond. They have to sell a bond. Now they can't sell it. They have to sell it through a brokerage, a bond brokerage, and that determines what the price of the bond will be. I used to work for a large public utility, and every year we would have the bond analyzers come and look at the facility. And this was about a $7 billion facility that I happened to have my office in. And these guys would come and we would take them out on Lake Powell, feed them shrimp and wine and dine them to show that we were a good, clean place. And this was a power plant. So they would go out and they would clean up all the coal and make everything look nice. So the bond evaluators, or the bond analysts is what they call them, the bond analysts would give us good points, because that determined what the rates would be that we could sell our bonds at. In other words, we needed to raise, at one time we needed to raise I forgot what it was, $500 million for an expansion that we were doing. And the bond analysts come and they look us over, and then they will rate our bonds. They will rate us as, what's the likelihood that we're going to pay it back? This is no different than what you do with your mortgage. If you needed to put something on, and if you wanted to add an addition to your house, you wanted to add in a whole new wing to your house, you got to go raise money. Where's the money going to come from? You're not going to save it. You're going to go borrow it. And by the way, this is important to understand, you guys. You know, there's a guy in this. I mean, I sound like I'm going after him. I'm not. But people say, I want to be out of debt. I want to be out of debt. Do you realize what would happen? I was telling somebody this week, do you realize what would happen if everybody in the United States was out of debt?
Yeah, the banking system would collapse.
They're being.
Our economy would collapse.
Our whole economy would collapse. Now that you think about that, because you're driving a car that's probably financed, you're driving on roads that are definitely financed, you're driving up to a school that's obviously financed, and those are all done through bonds. Who do you think buys those bonds? Insurance companies. The insurance company buys. The insurance industry is massively, massively tied to our whole economy, and the whole economy is based on trust and working. You know, and as the economy falters, it's because consumer confidence wanes. Consumer confidence lacks a little bit because people don't have the confidence to go out and buy a new whatever, and that's what slows down the economy. So the whole system runs on leverage.
Go ahead.
And we stop and think about it, and we think, well, it would be good if nobody. I mean, I want you to be out of debt too. I'm not saying that, but I want the debt that you do have, I want you to own it, because somebody's going to own it. Do you want me to own it?
No, we want to have that. It's an asset, you said. I've learned that.
That's right. So that's exactly right. So to a banker, a loan that he has out is an asset. And think about this. He hopes you don't pay it back for quite a while, because he'd rather get that 5, 10, 15, 20, 30% interest. And they're not going to help you get rid of it. They want you to have it. Anyway, we kind of digress here a little bit.
Yeah, I have a hard stop. I got to hop on to another meeting, but I appreciate everything. It was really eye-opening about the IULs.
Yeah. Thank you. I hopefully, and if you have some specific questions about something that you've seen or whatever, you know, my email is jim@Creative Capital Strategies. Send me an email and say, hey, what's this all about? I don't understand this. And we'd be happy to try to jump on and answer it for you. And Christy and I are both all about wanting you to understand what you're doing. So I don't do anything that you don't understand. Okay.
Okay.
All right. If you guys would please tell us what you think, what you'd like to see. We'll see you next week. And next week is for an advanced group. So those of you who have policies with us, you're welcome to join that. And those of you who don't, you're welcome to get with us. And Shane, can you put a link in there as to how they get a hold of us if you want more and want?
Yep, it's in there. It's in the chat. I can post it again if we need to.
All right, very good. Thank you.
Uh-huh.
So with that, we will let you guys go. Any other questions you guys have got? Come on,
No.
Ken, you got a question. I know you do. Ask me, Ken. Okay. If
No
not,
question right now. I'm
question.
writing.
no, you're writing. That's good.
I have a question.
Yes, ma'am.
Hi, this is Jasmine.
Yes.
I've been working with you. I actually supposed to be meeting up with you on the 4th. You told me to get the information from my my insurance and stuff. Are we able to chime into that meeting, or since we're in the progress, or how does that work?
This one on this next one, you mean?
Yes, the next one.
Yes. If you're in the process of working with us, then we consider you clients. So
Okay.
yes, you can. Yes.
Okay. Now, also, I haven't received that yet from them, and we're set up for the 4th. Do we need to push it back, or?
Yes. If you don't have it, well, you're asking for your in-force illustration, or what are you looking for?
Yes,
Yes.
the enforce.
This one with you, as I remember, it's not necessary, but you will need it the time after that. So let's go ahead and meet
Okay.
with. Okay.
Okay, perfect.
All
All
right,
right, till
good.
then, May 4th.
All right. See you then. Thank you.
Mhm.
Anybody else?
No.
Dan, what do you, go ahead. Anybody?
I'm going to tell you something about bond measures. I work at a school, and what I really take issue with is that it affects my property taxes. Only those who pay property taxes. It goes on a bond measure on the ballot, and our school, nameless, really sells. Oh, it's for the kids. It's for the kids. And I've looked at their line items on what they're spending money on, and I'm just like, this is
Yep.
not great.
I mean, I in one of my former lives, I was in the education world, and I know it's difficult because they have a hard time selling it. And I mean, we live out here in the West where things are just, I mean, I live in the fastest growing city in the country right now, and we're building hospitals and we're building schools and all kinds of stuff, and all that has to go through bonds. And so,
People that aren't homeowners, they get to vote on it, and they say, "Oh, it's for the kids." Bing! Our policy, our property taxes just skyrocket.
well, that's because you're wealthy, Deanna. That's why that's going.
You've
Oh,
seen my
they
not wealthy.
forgot to tell you, huh?
You've seen my returns. I'm not wealthy. Also, this whole UI, whatever this system right here,
IUL?
it sounds like that's what is written in the Constitution for California. I'm telling you, that's how they operate. They change the rules when they don't get their way, and when things, ugh. All right, I gotta go.
I was going to say that. So if the school is trying to raise money through a bond, and they have to, there's a certain amount that they can bond without permission and it always changes wherever you are. But if it doesn't get approved, then the school has a problem, because what are they going to do with all these kids that are coming in from all over the place? There's no place to hang them. They're hanging them on the hooks everywhere. And so then they have to go out, and but here's the thing, they can go out and rent facilities because it doesn't show up. And that is, it's the way we do it. I'm not saying it's the best, but that's the way we do. But we're considered compared to how other people raise money all over the world, it works pretty well for us.
I did ask how, how the banking you taught us that, that banks buy insurance policies on their employees so that they can do their benefits. So I asked ChatGPT about my specific institution and how they do it, so I could learn. And it's not that, but it's very, very, very similar. It's really close.
There is a link that I could send you if I was better organized. I'm in the process of changing from one computer to another, and I just don't ever have time to get it done. But
I get that. That's okay.
There's a link that you can go to, see if I can, where you can go and see what your bank is doing as far as.
Oh, you sent that to us before.
Yeah, we've gone through it a couple of times, but I don't know where I can put my hands on it right now.
Oh, I saved it somewhere, but I'm not organized either. So, and I'm not changing new computers.
Yeah.
Okay, I'm gonna bounce off. Thank you guys. I'll see Shane and Christy on Wednesday.
All right. Look
All
forward
right.
to it.
Thank you guys.
Take care,
Have a
my
good one.
capital problem. Bye bye.
Hi, Deanna.
All right. Jerry Bresnahan. How do you say your last name? Jerry
Bresnahan.
Bresnahan. Jerry Bresnahan, right?
Yeah.
There we go. I got it. There we go. Any questions for you?
No.
You just
Although,
check into. You just
I
check
just
in to
have a
keep us
comment.
honest. What's that?
I 100% believe in this movement. If ever you're looking for people to sell, in our area, I live in the Cleveland area. I would be open for training for that.
It's interesting you should say that because Christy and I are having this discussion, and it's a debate we have from time to time. So do me a favor and send me an email and just say, hey, I'd be interested, and I'm in Cleveland, and we'll see where it goes. I will tell you, it's a doggone steep learning curve. But if you want to keep
I imagine.
if you want to keep your cognition going, it's good because it does keep you on your toes.